Welcome to Season 4 of the NAC 4 Business Podcast.
We have a question for you as the audience. Are you keeping the right records to protect your business from CRA strife? We'll share why record keeping matters, how long you should keep your files, smart ways to stay organized, so your business can thrive. If you've ever worried about messy books or a surprise audit, stick around. This conversation could save you time, money, and peace of mind. Eric is our guest. He's Eric Sonego from CAPROS. He's a seasoned accounting management consultant from CAPROS who's been serving businesses across Eastern Ontario, Western Quebec for 25 years. Based in Canada since 1981, Eric brings global credentials and fluency in English, French, and Spanish to the table. He works with corporations, not-for-profits, franchises, and Indigenous communities alike, helping them turn ideas into viable, sustainable enterprises. Eric's deep expertise spans accounting, tax strategy, and operational consulting, and his passion lies in building trusted relationships through clear communication and personalized service. Proud parent and a dedicated professional, and someone who generally wants to see your business thrive. And he plays soccer too, as a sidebar. Eric, good to have you back again.
Thank you very much, Bernie.
Oh, you're very welcome. And, do you have a favorite quote or saying, sir?
Life quote, businesses attract the people they deserve.
That explains more than I'd like.
So when a business doesn't track its records, doesn't do good record keeping, and whether it's for financial or other activities, what's the cost of the business?
Well, it would be equivalent to you blinding yourself with a blindfold and walking around a day, and if you could walk around without hitting anything, or you could hit everything in your house or in your business. And that is what happens when you don't have record keeping. You just don't know where you're going.
So is that a bit of a stress factor for businesses?
It is, because record keeping really starts with planning and with forecasting. You have to forecast something that you're going to do. And people are really afraid of forecasting, because it ties them up to a delivery and to a performance. Businesses are no different, so they hate forecasting. And even when you do a forecast for a business, they might hide it and put it in their fourth drawer and not refer to it, and only use it for banking purposes to show the bank. I would say that not every business manages with records that are anticipatory. They manage with records that are reactionary. They react to what you've done. And that's what the government wants. The government wants records that record what you have done. Unfortunately, that's not enough for a business. You also have to have records of what you will be doing, and that's called planning.
Eric, 40 years ago, the whole process of getting financial documents to the government was a much slower process. You did your bookkeeping, and then a year from now, somebody haunted you from the CRA, and you sent them a file, and 8 out of 10 times the owner didn't understand what the numbers were on the paper, and he's living by, or her, but usually it wasn't him that made this mistake. They live by their bank balance, not the financial statements. So
Yes.
How do you train a client that if he wants to do all he can do, he actually has to know his numbers to work his numbers?
That's a good question. That's a good comment. But, small business in particular needs to manage using the cash flow method. In other words, what you have in the bank is what dictates what your next position is going to be, what your next thing is going to be. And that's cash flow. And forecasting cash flow is part of forecasting. That's what we call it a cash flow forecast, because it's forecasting your cash at the end of the bank. The difference between that and financial statements is financial statements is more of what happened last year, what happened last month. It's a historical thing. And in the long run, after 2 or 3 years in business, the financial statements are helpful in seeing the trend of that business. The cost trend, the ownership trend, it sees all of that. But on a day-to-day basis, sometimes it's better to see what the bank is doing than what the trend is. So you need to have both. You need to have financial statements, and you need to have something that moves into the future, which is forecast and cash flow forecast and employment forecast and all that kind of stuff. If you're a construction company in the month of November and you're bidding for jobs, for instance, you need also to forecast how many employees you're going to have and where those employees are, and who's competing with you, or the employees, and what's the difference between you and the other construction companies in attracting employees. So that will never enter into a financial statement, and that might never enter into a cash flow, because it's something that doesn't happen until you incur it, but you need to forecast for it.
It's interesting how you're mentioning all this. Even if you have employees, because although your record keeping just indicate your performance, so you know that, are you viable and so forth. But it's not only your information; it becomes information that you push out to other people, like clients or your
Right.
investors, or even your staff. Like, do you have enough to meet payroll?
Yes.
So no one likes doing that for free, and they don't want to take shares of the company per se always, unless of course you're Apple. Is this something then you've seen other businesses where really good team, really good people, really good product, but the record keeping actually stymied their growth because it's
Yes, I think sometimes people are, they look at the pounds without taking care of the pennies. I think that part of the problem is that, like last year I had the experience of someone who did not who did not want to use my services because, quote, were too expensive, and they went to a bookkeeper, and of course the bookkeeper is a great bookkeeper, but they're not an accountant. So what happened at the end of the year is that they would bring the bookkeeper stuff for me here to review, and until I got tired of it, and I said, sorry, we either do your books or we don't do your books, and if we don't do your books, we're not your, and that place is near bankruptcy now after 4 years in business. And I think that guy or that gentleman wanted to save money in places where you're not supposed to save money. You don't save money in accounting, and you don't save money in legal services, because those are the two things that are going to keep you afloat, the two things that are going to keep you out of jail, the two things that are going to keep you out of trouble. Those are the only two things. You can save money on advertising, you can save money on employees, but you should not save money on accounting and law and legal services, because if you need those two things, and by the time you want to change your mind and get the accountant and get the lawyer, that's too, the horse is already left the barn. There is very little we can do. So you need to have that before you start making mistakes, not after you've made the mistakes. No, that's negative talk from an accountant, but that's reality.
Eric, you've been at this a while, and I remember when there was all these places where the documentation between where it was created and where it got turned into a financial statement, there was all these places where they could drop and fall through or get delayed. Tell me about where technology has helped get you from the cash register or from the mail, from the checks coming, to a financial statement that either you didn't expect 30 years ago or is doing very, very well now that you didn't. Yeah, tell me a story.
Well, technology is making record keeping almost seamless, and yet you have the same amount of people who are not doing the records. So technology is there, and technology does the type of record keeping that we could not do as humans. For example, if you have a scanner, there are accounting programs like Xero, like QuickBooks and Sage, that you can put your whatever happened today, you can put it in your scanner, and after 2 or 3 months, it learns your expenditure places, and after 2 or 3 months, it does all of your record keeping just with the scanner. But the beauty about it is that if CRA comes to audit you and says your telephone, what happened with your telephone expense, you hit telephone and it will give you the 8 or 9 telephone receipt bills that you actually scanned. So it gives you information that you never had before, that you had to run around to find before, or that you lost before. Once a month I empty my wallet, and we put it through that kind of digitalization. And one of the reasons we do that is because a lot of the receipts I have in my wallet right now come from businesses that use electrostatic paper. The stuff the gas station gives you and some other restaurants give you. And that a year from today, that receipt will be illegible.
It'll be invisible.
Yes. So if you scan it, it becomes and that's the beauty of technology today, that you can make a lot of receipts permanent that you could not do before. And if you did poor record keeping before, you lost those receipts. So record keeping has improved with technology, and the government ability to look at records has improved with technology. So they have tools that they didn't have 30 years ago to review your stuff, to review your records, to assess whether you are pushing the envelope too much or not, or you're staying inside the envelope. To do all of that, they have the type of software that can do that now.
You mentioned, like a year from now, receipts, the gas receipts, and I know they're notorious for fading over time, unless of course you put them on a seal, but they degrade.
Yes.
What is the length of time you hold on to things? Like, if you had payroll documents, if you had tax submissions, I know for personal use, I think it's 7 years you have to hold on to your any documents you file for personal tax.
You hold on to permanent stuff, things that are record permanent stuff, like your general ledger for 7 years. Stuff that does not record any permanence, that just records transactions, like your telephone bills, you hold for 5 years.
And employee records or employee
records are not as important as people think, because you're filing them with CRA. So if you're filing your payroll properly, they have your records already, and you can get them anytime you want.
So they're storing it for you.
Yes, but they're storing summary stuff like T4s and T4 summaries and T4As that belong to your company, let's say. So you might not know, if you paid someone on July 27th $400, but you know that during that year you paid them $14,000.
One thing, Eric, that I was true 30 years ago, and I don't know if it's still as true, is business owners confusing revenue and profit. The most obvious would be the taxes, where they spend that 13% that it wasn't even theirs, and all of a sudden they have a $200,000 tax bill. They're bankrupt and they had $1 million business. Could you fill that in for me?
Yes, well, that squirts the issue of the sales taxes. The sales taxes, you are hired by the government to collect their money, and you should have a separate bank account for those sales taxes. If you confuse that, 13% can add up to 100% pretty fast. After 7 years, you've kept 100% of the government money, and that can be pretty painful, and that can lead to bankruptcy.
And they frown on that at CRA, I understand.
Yes. One thing we do when we do a year end, for instance, is we even if the company does their own GST returns, we require that that we have them here. And then I will compare their sales to what they declare to the GST. And I would say 30% of the time, the sales that we have for financial statements do not relate to the GST sales. And we have to have a talk with the owner of the place, right? With the client, we have to have a talk with them, because we will not file a financial statement unless GST for sales agree, or there is a good reason why they don't agree.
What are the typical reasons for it not to agree?
Typical reasons could be that, the sales for GST included only Canadian sales, and the sales for financial statement had both US and Canadian sales. It could be that the sales for GST were done on a cash basis, and the financial statement were done on an accrual basis. And if that's the case, we can always adjust the financial statement, or make a note on the financial statement that GST returns were filed on a different basis.
So when you go to fix a messy books, you get a client showing up. Well, they know they need your help. They know you need your expertise. They know they need the accountant and the bookkeeper. Let's say they've been doing it themselves. Maybe it's a proverbial shoebox, and they come see you. What's the best place for them to start fixing that process, the messy books, other than, hey, Eric, how you doing?
If it's a one person in the business, that does work on the weekends only, we don't worry too much about that. We can put them in touch with a simple record keeping program. We can give it to them from here. We give them a box with months and with envelopes for different expenses to put it there, and we say 6 months from now come and we'll take a look at it again. But that's the one-person business of someone that does consulting. There's no employees. There's one invoice a month that goes to their government department or whatever they're consulting at, and that's it. And they might have payroll for themselves. So, we do a few of those, and that is very simple record keeping, even if we do it ourselves. But the record keeping starts hurting the business when it's, let's say, home renovation company that has both employees and subcontractors. So that place might get away for the first year with having record keeping. But when they come here, the cost of us fixing it is so exorbitant high that they will never do it again. They will say, "Can you give me the name of a bookkeeper?" Or we will invite a bookkeeper to come and work with them.
So
because that kind of place has problems with WSIB reporting, GST reporting, payroll reporting, and sales tax reporting.
So how do you figure if you're to budget? Let's say someone's starting a business and they go, "Okay, I'm a solopreneur, or maybe I'm a like you said, I'm a renovator contractor." How should they figure out their gauge their expense for an accountant and a bookkeeper? Like what's typical rate? Assuming that you're not coming into a fixed, geez, that's nice spaghetti, and now we're gonna
Yes.
make everything nice and straight.
Well,
How do you?
a solopreneur that we do 5 or less hours of bookkeeping in his file to finish his financial statements, he should be spending around $2,500 a year in year-end stuff. A renovation company, if they do no bookkeeping whatsoever, and we have to do it all at the year end, you can add $7,000 or $8,000 to that $2,500.
So far better to do it ahead of time.
Yes, and by that time, they're already late with the reporting. CRA is already down their neck, so we have to do a lot of CRA work, and CRA diplomatic stuff on behalf of that business. That is time that we have to spend on it because they haven't done any record keeping. That's why if you're going to start a business like that, you should come to an accountant and have at least every quarter reporting.
Let's assume that a firm is doing a fair amount of volume, and to track the paper, they want to hire someone internally from getting the mail to getting the checks in the bank. How do you, if you don't want to sit on their stoop every month, how do you make sure the person's doing it to deliver you the information you need in a way that will fit in your system so that you're not just redoing the books and pretending they're getting bookkeeping done? Which I've actually seen happen.
Yes, because if we design the system of what they should be doing, if we design it and we put periods in the year where where we go and visit, then we don't anticipate many problems. If you're not part of the hiring of that person, if we have not put the system together, well, maybe they have records, maybe they don't have records at the end of the year. So if they don't have records, then we have to design the records now to fit the person that they have. But it's too late for last year, and we're looking at this year, and that means that they're going to have a bigger accounting bill this year. But in fairness to business, they don't get into problems like that if you are in the construction trades, because everybody in the construction trade is kind of spied upon by the WSIB, by the workers' the union, by the guilds, the electricians, you name it. You are not working in isolation if you're in construction. So they know about record keeping, they know about accounting, and those tend to be our better clients, by the way, because they already they know where they're going. They know that record keeping is important. They divide their work by project. So we get 45 Maple Street. We have a whole file of 45 Maple Street, right? So the only thing that will get you problems is if you use your bank account for more than business. That's what
Commingling, they call it.
Yes, commingling. That will get you into trouble. And that will get you into major problems with the CRA.
So what happens if you don't have paperwork when CRA comes knocking? Like when your records are, you have some, but it's like spotty.
Okay, so let's say you don't have any records. You drive a 1999 Civic and you live in a poor part of Vanier. You can claim that you're not making any money, and they might believe you. And they might tell you, that they're going to do an assessment based on what they see. But let's say you are like most of us. You live in the suburbs. You have a house that's appreciated to next to $1 million. You have a late model car, and you have the audacity to say to these guys that you have never made a penny in the last 15 years. If that happens, they do a net worth, and they say, well, to get that house, to get that car, to get that trip, to get all of that personal stuff, you must have made $150,000 a year, and that's going to be what we're going to tax you on. In my years of practice, I've only had 2 net worth assessments.
That's a very nice low number.
Yeah, I've only had 2 because we've been able to close the barn door before the horse left. And we do that by, if the client comes to us and we know they're going to do a net worth assessment, we do financial statements before the CRA has a chance to come. We advise the CRA that we may be a bit late, but they have to wait a little bit, and we'll be filing it. We advise of all of that. But it's doable. But so in the last 30 years, I've only had 2 where net worth assessments were done, and I haven't been surprised. I haven't been surprised. It's not like it's shocking to the office. We knew that it was coming.
Eric, do you find that you try to train business owners to treat themselves as managers, decide what they need to make a living a year, and actually take that as a salary or some form of a draw so that they know what they're living on and it doesn't screw up their current bank account?
Yes, we insist that they should be on payroll, even if the payroll does not take into account all of the draws. And so we insist that because it's better to owe taxes on $20,000 that you took as dividends or that you didn't claim and have a payroll of $50,000 than it is to not have claimed $70,000. So we make sure that and we do that almost every January. We make sure that they're still on payroll. So we make sure that they're on payroll, and it's a payroll that they can afford, amount that they can afford, because there's deductions that they have to have as well, right? So we make sure that the business can afford that, and we make sure that they can live with that payroll. But we say, if you're making more money, give yourself a dividend, every 2 months, every 3 months, give yourself a dividend. Write it down and tell us. And we will do a T5 at the end of the year for those times that you took more money, and your T4 is done, your source deductions are paid, and the government is not going to be screaming at you, and you're not going to be into tax problems.
So if you're running a business and let's say you're in the startup phase, and if you have cash, let's say severance pay or retirement, or if someone,
Yes,
bequeathed you some money, and do you structure that as in like you just dump the money straight into the business account, or do you structure it as a loan to company? And is that taxable if you're not getting an interest rate on it?
yes. Well, I tell people that there are 2 banks in a company: the bank on the street and the owner. And the owner is a bank of the company. So you have to treat yourself as if you were a bank. So you have to, including having a loan agreement. Here, I'm lending you $5,000. Loan agreement for $5,000. You have to make sure that you, at the end of the year, you put that in your minute book, because CRA will have the position that if it's not a loan in the minute book and you took money out of the company, that is not repayment of the loan. It's just taking money out of the company. So you have to do that. But if you look at yourself a bit distant from your company, from a record keeping point of view, if you treat your company not as your kid but as your worker, you tend to be able to be more realistic about what the worker can do. If you treat the worker as your kid, then you will give the benefit of the doubt to the company all the time. You will put more money than you deserved, than deserves, and you will not work as efficiently because you will always say, well, I can lend the money $1,000 next week. It doesn't matter. And that's when you lose track of whether you're making money or not.
Eric, one of your clients has somebody come to them and says, I think you should buy my business or we should merge. If you're involved early and they didn't bring you in the last minute just to tell them the mistakes they've made, how do you help them get a smell test? How do you sense that what you're seeing isn't what is reflected?
And most of it, I would say that 100%, I would even go say 100% of the time. That never happens here because we know the client. We've known the client for a number of years. So we know, we have been told for the last 2 or 3 years that they were merging or they were selling or they were doing something. So we're ready for it. We are talking to their lawyers. We're talking to them. We're ready for it. We have the paperwork in place. The only way that someone not telling us would happen is someone who changes accountants, and comes to us the year that they're merging, the year that they're doing that. That we are not as good as we should be because we don't have the information, and we are putting out fires rather than doing work. We help them as well, but they are not helping themselves. They should have been talking to us, not the day they came here, but when they changed accountants, that the next day, they should have been talking to us, not at the end of 10 months coming to us.
So for non-for-profits, community organizations, or charities,
Yes.
record keeping, does it differ from that than, let's say, because they're all businesses, right?
Yes. Theoretically, no. No, because a debit is a debit, a credit is a credit. Theoretically, no. Taxation-wise, yes, because they don't pay any tax. But a charity that has, well, the most entrepreneurial business that I've ever been involved with in accounting was when I was a student, and the firm that I was with did the YMCA of Canada audit, and the YMCA does not act like a nonprofit organization. It files taxes as a nonprofit organization, but it doesn't act as a nonprofit organization. For instance, if you want to play paddle ball with them, they're not giving it to you for free. They cover their costs, they cover their training, they cover their ball, they cover the paddle, they cover everything, and then they charge you. But I have nonprofit organizations. Some of them are my clients that don't do that. They think of themselves as messianic, for lack of a better term. They're messianic. They are here to do good for you, and who cares about record keeping? We can do that at the end. And there's some very good examples. I mean, when I teach in university the accounting, I will give examples of places in Ottawa that act like that are messianic in nature, and are always broke, But
So it sounds like you have to have a business plan, like going, much like in a business.
Yes.
Here's your expense and here's the profit.
Yes, but like in accounting, you see both sides of the individual. The boardroom side and the backstreet side. So take the places that are big charities like the Canadian Cancer Society, and I don't want to pick on them because they're a good place, but places like that have people who look at the paper every day to see who's died, and then they look up. They call if they see that it's one of their donors. They call the trustee and the executor, and they say, "Where is my money?" Right? So they are mercenary in getting money. They're not like some other charities that say, "Oh, can I have $5 for membership, please? Oh, can I have $10 for membership?" They have people employed that their only job is to go through the obituary and see who or their donors have died, and they pay a good salary to those people, so it must mean that they catch a lot of people. And I know a lawyer in Ottawa that used to tell me that he hated to do estates because the day after, it wasn't the kids who were screaming for the money, it wasn't the ex-wives who were screaming, it was the charities who were there screaming. And those charities are the ones who are well managed, by the way, who have professional management, who are well managed, who know where their income is and want to get their income here today.
Eric, we live in this global world, we're on Zoom now. How do you deal with the IRS and make sure they only pay tax once?
That's difficult because, especially if you're a Canadian, because in Canada, we are raised with the CRA, who are civil servants, and act like civil servants and behave like civil servants. And we have a very civil relationship with them. The IRS, depending on what level of IRS you're addressing, the IRS sees themselves as a police force. Some of the IRS departments are armed, and it's a totally different relationship than you would have with the CRA. So when you discuss international issues, the Americans are statute oriented. If it's not written, it does not exist. There is no, grayness. There is no, that was done by my mother when she was senile and she didn't know what she was doing. There's nothing of that. It's by statute. In Canada, it's discussion. You discuss it with the government. You file the right forms, but you discuss it with the government and it stays assessed here. In the US, first of all, they don't want to have residents now, so they want to make that person a non-resident so that they pay higher tax. So a lot of those snowbirds, one of the reasons they sold their homes in Florida, yes, Trump could have been a reason, but you never look at that top, that top who's screaming. You look at the bottom and see what they're doing. The state of Florida has two types of property taxes: one for Floridians and one's for non-Floridians. One's for people with a different passport, foreigners, and the foreigner pays 2 or 3 times as much as the Floridians, even more. The other thing is that they also allow to do things in the U.S. that we in Canada would advise against doing, especially people owning real estate. And in the U.S., they're used to depreciate the real estate, and then they tend to pay that back in taxes when it happens. But they tend to have income from other sources because they live there, and they tend to plan for it because they live there. If you are a snowbird and you have property in the States and you have depreciated, when you sell that property, you will have to pay a higher capital gains than the American would have paid. You have to pay the same capital gains in Canada.
So you have
Now,
to pay twice.
Kind of. Canada takes into account the taxes you've paid to the States, but not 100%. It's a percentage of what you paid in foreign tax. So you will always pay tax in Canada on it.
Eric, how do you help entrepreneurs view record keeping as a management tool rather than a chore?
By, like if it's a one-person business, I would say to them, just put it in these envelopes, bring it every 3 months here, we will do the records. Okay, that's a one-person business. If it's a company, we will say to them, you have to buy an accounting program. You have to hire a bookkeeper. If you buy an accounting program, make sure that it's on the cloud so that we can see it. Okay, so if we can see it, then we know whether you're getting lost or not. And most accounting programs today are cloud-based anyways. So that's not a big deal. So there are tools available for companies not to misbehave in record keeping. So we see a lot less of them. Like right now, and this is sad to say, because the economy is not as good as we think it is. Right now, I don't have any retail that's still alive in Canada. And my firm, which has 7 offices in Canada, does not have any retail that's still alive. And that is a problem. Retail cannot operate without record keeping. It's impossible for retail to operate without record keeping. So we would catch them before they start or a month after they started, and we would design the records for them. We would put them, we'll have a back office system and we'll have a front office record keeping system so that it dumps it into the accounting system. So someone junior can do the front and someone senior can control the back. But that happens quite often in retail. But the retail is having such a horrible time that I would not be seeking clients in that world. The ones we've had are either on their way out or are out already. And I'm talking about places who who had one store places or two store places, in the market, who sold, women blouses or model stuff, places like that have not been able to survive COVID. They just gave them a bit of a death blow, and when they came back, the market was no longer there. Like some of the stuff that's happened in record keeping to people is that, or to businesses, is that when a pandemic happens, the economy that happens afterwards is not the same economy you were at before. And unless you've adapted to that, you cannot do it. Even if you're big, like the Hudson's Bay Company.
Yeah, really.
Even if you're big, you cannot change.
Eric, how big an area do you serve, and how do we get a hold of you if we're a good fit?
Right, so I serve the Eastern Ontario. We have firms in Toronto, in Guelph. We have a firm in Quebec. We have firms in Manitoba. We have firms in Saskatchewan, and we have firms in BC. So, but I am the one in Eastern Ontario, and I am the guy in charge of taxation for the firm. So
Cool.
when there's a headache, I get it.
And are
Eric
you on
says
LinkedIn?
yes.
I beg
Do
your
we go
pardon?
to LinkedIn? Do we phone you? How do we find you
Oh.
easiest?
So my phone number is 613-254-7. And I am here. Like it doesn't cost any money to call me and ask for advice, and to come and meet us. We don't charge for that because we want to be able to. We're also studying the client. So when I get interviewed as an accountant, I'm also psychologically interviewing the client. So it goes both ways, right? It goes both ways. We have to make sure that we're a good fit, us and them, and we can refer them to other people if we think that we are not a good fit.
I want to say thank you to Eric Sonego, my co-host Wayne Pratt, and you, the Knack for Business listeners. So listen, your records are kind of messy, you need some clarity and build up that confidence and gain control of what you're doing. Reach out to Eric. They can help you focus on growth instead of stress. His passion is making record keeping a simple, powerful tool, and actually not just making record keeping a simple and powerful tool, but also the accounting piece, because that's going to be driving everything else.
To reach the podcast hosts, email them at info@creativeinsight.com or by the website creativeinsight.com, spelled KREATIVISIGHT.com. To reach Wayne at his email, wayne@motive8u.ca, that is MOTIVE, the numeral 8 and the letter u.ca, or his website, motive8u.ca. If you would like to be a guest on this podcast and share your knowledge, let us know. We would also appreciate your feedback on the content or format. Check the show notes for more details. For these podcasts, we like to acknowledge the support and thanks to the following people. Carl Richards from Podcast Solutions Made Simple, a renowned podcast expert. Fred Crouch, who is the Property Wizard podcaster, where Bernie is a co-host. Jovan Strika from At Hive, a co-working space that is more than just a space. Then Melanie Weber, Bernie's invaluable business partner, and Wayne Pratt from Motive8U Inc., who serves as both a coach and co-host of these podcasts. Disclaimer. Please note that the Knack for Business podcast episodes are meant solely for educational and general informational purposes. The information and opinions contained within are not intended to be professional advice on any subject matter. The thoughts, views, and opinions expressed by the participants are their own personal beliefs and do not represent the views of the podcast hosts or any affiliated organizations. It is important to note that this podcast is not a replacement for consulting with certified experts in your area who possess knowledge of your unique situation. The hosts of the podcast, along with any participants or affiliated groups, do not take responsibility for any actions taken or not taken based on the information presented in this episode. It is highly recommended that individuals seek guidance from their own personal advisors in fields such as accounting, law, or other pertinent areas prior to undertaking any actions or making decisions that may impact their financial, legal, or other aspects of life.